Hi everyone, I'm Piotr. I'm co-founder and CEO of StableWatch. We're an ultimate hub for all things media and analytics for stablecoins. And today I want to talk about yield risks when it comes to stablecoins. But very sad to tell you that you all been racked once again, because 10 minutes it's not enough to talk about everything you need to know. But I'll try to make it for you. Okay, so while we talk about risk, I think it's important to remind ourselves what should be our comparison. So risk-free rate in TradFi is is a situation where we put our money to work and expect no loss. And we think of T-bills and treasury bonds, so US debt as such investments. And at the moment, they're yielding about 4.5% APY. And any other assets would go into the other bracket, so asset with a risk premium. That means that we can expect higher revenue, higher yield, but we also take in much more risk. And we don't think that the treasury bills and treasury bonds have these risks because US always can print more money, and thanks to that, buy its own debt. This is also why Bitcoin was created in the beginning, and that was before we thought that it's better to pitch BlackRock to buy some Bitcoin. But it's not only digital assets in this bracket, it's also stocks or any other investments, really. And is there a risk-free rate in DeFi, especially while we're utilizing our stablecoins? Unfortunately, not really. So it's 2025, and still you as a DeFi user can't put your money, your stables to work, go out there for 2 years and come back and feel safe, mostly due to two big factors: hacks and rugs. So just last year, we've lost 2.2 billion worth of dollars of assets in DeFi hacks. And this is around 7.5% of North Korea GDP, actually, so quite a lot. This is happening still, and whatever kind of assets you get exposure to, T-bill wrappers, etc., you still exposed to this kind of risk. On the other side, there are racks. So still, unfortunately, there are some teams which can just go away with your funds, first luring you to their protocol with high APY. So is there anything close in DeFi and in stable coins? So we call it Proxy, risk-free rate. And over the years, it seems that we as industry have chosen Aave mostly to make this comparison. So if you utilize your stables in Aave, you will get 1-digit APY on your investment, and it's as safe as it can be when it comes to DeFi. Some other sources here of this risk-free rate in DeFi could be also Curve, LP fees, and this would be really it. Over years, those were two main opportunities to get risk-adjusted yield with utilizing your stables. But recently, we see much and much more new products coming to the space, like tokenized T-bills. But unfortunately, here on the economic side, you're pretty safe because those are like US treasuries, right? But still, you're exposed to risk of hack. Some other are yield stablecoins. Some of them got very vanilla mechanics and are as close to safety of Aave or Curve, but still you need to be very careful. And then more and more TradFi institutions are coming on chain. So there's a lot of real world assets coming, also letting you utilize stables in this space. But the spectrum here is very broad, as tokenized T-bills are on the one side, but you can also invest in car loans or some wildcat lending products. So what are the pros and cons of yield-bearing stable coins? They're fun because they provide you more APY. At the moment, they yield around 5 to 12% yearly, which is really great for a lot of users. But as you can see, the table with risks is longer than the one on the reward side. You're still exposed to DeFi hacks. We already spoke a little bit about this. But besides just smart contract hacks, there are also risks associated with bridging, because a lot of those funds can be flowing through different chains while you put money in such coins. Some other risks are liquidations and oracle issues. And just last month, I've seen 3 this type of issues within the YBS space, and I think around 3 million worth of dollars was liquidated due to that. Some other risks are misallocation risk. So whatever kind of YBS you put in your money into, you will be using different strategies. And it's very important to understand how your money is going to be utilized. That's going to be on the next slide. And lastly, there's also a lot of examples where assets are stored off-chain. But fortunately, we started working on that as industry, and we try to do the reserve risk dashboards, etc. On the reward side, higher APY, also higher liquidity than vanilla T-bills, and it fully belongs to you in theory, because like Circle or Tether can froze your funds, and the same is the case for yield-bearing stablecoins in some of those protocols. But you can also find some which actually fully belongs to you when they are in your wallet. And what are those strategies actually to get yield on top of your stablecoins? So there are RWA-backed ones, as I said, and the spectrum is very broad. There are delta-neutral one, and here you can think of Ethena, I think, as the best example. It works until it doesn't. It worked when nobody was doing that, and today even Ethena is putting money into different yield sources and not actually doing arbitrage on the exchanges because it's not profiting that much anymore. Crypto-backed ones, CDPs, so the first examples really in the market who provided us yield. And here the biggest risks are bad debt and oracle issues. So we also kind of covered that. Next, we see now a lot of YBS wrappers. Those are kind of brackets or ETFs for different yield other coins. So such coin can get you exposure to Aave, maybe to some T-bill wrapper, Ethena, and a few others. So your risk is diversified, but there is then much more of a risk vectors associated with such a mechanism. Then there are a lot of exotic on-chain strategies. So recently I've seen coin which is yielding around 15% APY with GPU being in the loan within the mechanics. So there's a lot of interesting stuff here, and you need to evaluate them one by one. Then managed strategy, this is when a human is actually making actions with your portfolio. So I think it's pretty easy to imagine what can happen, what can go wrong. Algorithmic strategy is when bots or just the algorithm is doing such with your portfolio. So putting your money into different protocols, etc. But maybe once a year AWS is going down, half of the internet is not working, and actually a lot of those services also are hosted on AWS, and then you can have very big problem with stability of such a product. And lastly, there are trench products which are splitting the risk of different investments into safe part and more risky part. You can invest only in one, and then you're becoming a counterparty to a trader on the other side. Each of those got really different mechanics and different things you need to be aware of when you put in your money into those products. So as conclusion, there's no risk-free rate in DeFi. There's definitely a lot of things to say when it comes to risk and where you utilize your yield stablecoins. It couldn't be covered in 10 minutes, but as I said, there's a way to learn much more. Tomorrow in this venue, we're doing a workshop, and our head of research prepared a game. When within 1.5 hours, you'll be able to launch your own yield-bearing stablecoin on the testnet, pick few strategies from those we covered, and understand all of the risks associated with those strategies, and understand what protocols normally do if some error is happening. So just a reminder, you can scan the QR code. It's tomorrow 3 p.m., just another room, the workshop room, and hopefully it's interesting enough for you to join us. That would be it. Thank you very much. Yeah.